What's the future of the housing market? Are home prices rebounding? Or maybe the question is this: is the housing market stabilizing, or are we losing some of the gains from the pandemic housing boom? Additionally, does this stabilization imply that the national home prices have returned to their normal levels of growth? On one of my other videos, I shared what's in store for the housing market in the Bay Area. In this video, I will share with you what the experts are saying about the overall housing market. We all know what happened in 2020. The pandemic hit and wreaked havoc on everyone's lives. Despite the unprecedented changes happening, something counterintuitive happened in real estate. Instead of crashing, it went up like crazy. Unemployment during the pandemic skyrocketed as businesses got shut down, etc. Now, here's the thing about all the unemployment and all the displacement going on that no one talks about in relation to the real estate market. Most of the people affected by the layoffs are not the same people that could afford to buy a house. So there was no big impact on that side. The massive demand came from people being able to work from home. Or, as I keep telling people, if you can work from home, your company can send your job halfway across the globe. Anyway, that's a whole different topic, and that's not what this video is all about. Going back to demand. According to reports, because the pandemic pushed people not only to remote work, but also the need to get more space and get away from people, the result was that we had over 2 million new households that was formed. This far exceeded everything that was in the market, and according to the feds, we were about 300% short of housing inventory. Now, I have another theory about this surge in demand. I believe that all these home buyers that jumped in between 2020 and 2022, they just accelerated their plans of buying. It's not like these people had no intention of buying a house. It's just the pandemic, and with really super low interest rates, it accelerated pretty much everyone's plans of buying a home. What I mean is that this demand is not artificial as most people fear. More so in places like here in the Bay Area, our tech-driven economy, that even before all this started, the housing stock or inventory that we have were already not meeting demand. Even back in 2018, there were murmurs that the Bay Area housing market was overheating again because the prices were either back to levels before the mortgage crisis or the mortgage meltdown, or it has already far exceeded it. It was a very heated market, but the fundamentals behind it were solid. The buyers were well-qualified buyers with lots of down payment, unlike the mortgage meltdown. This overall surge in demand for housing far outpaced available supply, resulting in significant overheating of all across the nation. U.S. home prices went up to unprecedented levels. Between March 2020 to June of 2022, the Case-Shiller National Home Price Index went up an astounding 43%. That's already on top of steady price increase appreciation in the last 5 years. In fact, I had one client that bought in 2019, and by 2021, when they sold, they had almost doubled the price of their home. That was a combination of the still hot 2019 housing market, plus the pandemic-induced 2020 and 2021 market, and also add to that how crazy it is here in the Bay Area. And that wasn't like a one-off thing. Everybody that owned real estate pretty much experienced these increases in equity. Now, what happened in the second half of 2022 was that mortgage rates doubled, and as we fast forward to 2023, it's evident that the mortgage rate shock has effectively slowed down the housing market. National house prices, according to Case-Shiller, showed that in April, they remained 2.4% below the peak observed in June of 2022. Even though this is the case, there hasn't been a massive decline in prices. Surprisingly, the vast majority of the house price gains experienced during the pandemic have been retained even in Western markets just like ours here in the Bay Area. And we were significantly impacted by last year's housing correction. Last October, investment banking firm Goldman Sachs forecasted that house prices were going to be down between 5% to 10% from October 2022 to March of 2024. Now they're backtracking from that forecast. This is not the case anymore. I'm not bashing Goldman Sachs, but what I'm highlighting here is how fast things move or change in the real estate market. Their new report or forecast model projects a subtle increase in U.S. home prices as measured by the Case-Shiller Index, up 1.3 this year, followed by 1.7 next year, and then 2.4 in 2025 and 3.8 in 2026. To put this into context, since 1976, the average annual growth rate of U.S. home prices have been around 5.5%, which include the pandemic housing boom. So if you're following the news, a lot of this can be confusing and you may feel to you may feel a bit unsure about what's happening with home prices and fear whether or not the worst is yet to come. That's because today's headlines are painting an unnecessarily negative picture. If we take a year-over-year view, home prices did drop. I've said it before in my Bay Area and East Bay market updates. In some places, drops of over 20% has happened around the Bay. Another thing that I want to add is that this comparison of our current real estate market versus 21 and 22 are not a good comparison because the environment are totally different. And a lot of this has to do with mortgage rates, which I'll get to later. To avoid an unfair comparison to that previous peak, we need to look at monthly data. And that tells a very different story and much more positive story. While local home prices trends still vary by market, here's what the national data tells us. The graphs here use recent monthly reports from 3 sources to show the worst home price declines are already behind us, and prices are appreciating nationally. Looking at this monthly view, we can see the past year in the housing market can be divided into 2 parts. In the first half of 2022, home prices were going up and fast. However, starting in July, prices began to go down. You can see that in the red here. By around August or September, the trend started to stabilize. But looking at the most recent data for early 2023, these graphs also show that prices are going up again. The fact that all 3 reports show prices have been going up for 3 or more straight months is an encouraging sign for the housing market. The month-over-month data indicates a national shift is happening. Home prices are rising again. Experts believe one of the reasons prices didn't crash like some expected is because there aren't enough available homes for the number of people who want to buy them. Even with today's mortgage rates, there are more people looking to buy than there are homes available for sale. Mark Fleming, chief economist at First American, explains how more demand than supply keeps upward pressure on prices. History has shown that higher interest rates may take the steam out of rising prices, but it doesn't cause them to collapse entirely. This is especially true in today's housing market, where the demand for homes continues to outpace supply, keeping the pressure on house prices. Make no mistake about it, the slowdown in the number of transactions and the slowdown in price appreciation has to do with mortgage rates. If you're following mortgage rates because you know they impact your borrowing costs, you may be wondering what the future holds for them. Unfortunately, there's no easy way to answer that question because mortgage rates are notoriously hard to forecast. But there's one thing that's historically a good indicator of what will happen with rates, and that relationship between the 30-year mortgage rate and the 10-year Treasury yield. Here's a graph showing those 2 metrics since Freddie Mac started keeping mortgage rate records in 1972. As the graph shows, historically the average spread between the 2 over the last 50 years was 1.72 percentage points, also commonly referred to as 172 basis points. If you look at the trend line, you can see when the Treasury yield trends up, mortgage rates will usually respond. And when the yield drops, mortgage rates tend to follow. While they typically move in sync like this, the gap between the 2 has remained about 1.72 percentage points for quite some time. But what's crucial to notice is that the spread is widening far beyond the norm lately. What's pushing the spread beyond the typical average? It's primarily because of the uncertainty in the financial markets. Factors such as inflation, other economic drivers, and the policy and decisions of the Federal Reserve are all influencing mortgage rates and widening the spread. Why does that matter to you, or why you should care? This may feel overly technical and granular, but here's why home buyers like you should understand the spread. It means, based on normal historical gap between the 2, there's room for mortgage rates to improve. And most experts believe that this is what's in store for us in the future. According to Odette Koshi, deputy chief economist at First American, it's reasonable to assume that the spread and therefore mortgage rates will retreat in the second half of the year if the Fed takes its foot off monetary tightening pedal. However, it's unlikely that the spread will return to its historical average of 170 basis points, as some risks are here to stay. And so guess what's happening now? Home buyers are getting used to the new normal. In other words, home buyers are adapting to today's mortgage rates and getting used to them as the new normal, which in reality, if you were in the real estate market or business like me, it's more like a return to normal, nothing new. This is what I mean. Check out this graph. It shows the trend for the 30-year fixed mortgage rate from Freddie Mac since October. As you can see, rates have been between 6% and 7% pretty consistently for the past 9 months. When mortgage rates surged dramatically last year, escalating from roughly 3% to 7%, many potential buyers felt a bit of a sticker shock and decided to hold off on their plans to purchase a home. However, as time has passed, that initial shock has worn off. Buyers have grown more accustomed to current mortgage rates and have accepted that the record low rates of the last few years are behind us. They're gone. In fact, a recent survey by Freddie Mac reveals that 18% of respondents say they're likely to buy a home in the next 6 months. That means nearly out of every 5 people surveyed plan to buy in the near future. And that goes to show buyers are planning to be active in the months ahead. Of course, mortgage rates aren't the sole factor affecting buyer demand. No matter where mortgage rates stand, people will always have reasons to move, whether it's a job relocation, changing households, or any other personal motivation. The bottom line, the way buyers perceive today's mortgage rates is shifting. They're getting used to the new normal. Steady rates are contributing to strong buyer demand and consistent home sales. For the buyers, here's how this affects you. If you've been holding off on buying because you were worried the value of your home would go down, knowing home prices have bounced back up should bring you some relief. It also gives you the opportunity to own something that usually becomes more valuable as time goes on. Also, if you're waiting for mortgage rates to go back below 6%, that's not going to happen in the immediate future. Sellers, if you've been waiting to sell your house because you were concerned about how changing home prices would affect its value, you don't have to wait any longer because the latest data suggests things have turned around or things are turning around in your favor. So if you're waiting for prices to drop, that has already passed. If you're waiting for mortgage rates to drop back to levels like before, not happening either. If this is your mindset before you buy a house, sorry, there's no hope for you.